When the Facts Change is brought to you by the Spin-Off Podcast Network in partnership with Kiwibank, the bank for Kiwi looking to get ahead in business and in life. A bank that delivers expertise in banking know-how, smart advice for business owners wanting to invest, grow their business or diversify. A bank that adapts with technology through the lens of its people and customers. It is a bank with heart that is driven by its purpose. Kiwi making Kiwi better off. So what is the Reserve Bank and the official cash rate all about? Why does it move? Why does it not move? How does it affect us? What's the overall meaning of the Reserve Bank and the official cash rate? Well, it's designed to move the economy around, to slow it down, to speed it up, all with the aim of keeping inflation or getting inflation into the 1 to 3% target band over the medium term. And clearly, for the last 2 or 3 years, it's been out of that band, and the Reserve Bank wants to get it back there. That's why it started hiking interest rates towards the end of 2021 and has held it up there at 5.5%, the official cash rate, for such a long time. Through the last year or so, many in markets thought that by now the Reserve Bank would be cutting interest rates because inflation would have come back down naturally. The theory being that when you put up interest rates, you make it more expensive for a lot of spenders to go out there and consume and invest, and therefore they choose to hold on to their money. Also, it's a better deal if you put your money in the bank and do nothing with it. You get a higher term deposit rate. So that's the theory with monetary policy. And over the last 30 or 40 years, since we've had a free-floating exchange rate and a monetary policy with an official cash rate designed to keep inflation within 1 to 3%, that's been pretty effective. Monetary policy does work. It is blunt, but eventually it gets us there. Well, that's the theory. This week, the Reserve Bank held the official cash rate at 5.5% and extended its forecast track for the official cash rate out at the same level, 5.5%, towards the end of 2025. It delayed that first cut in its forecast by 3 months, and now it's possible we could have an official cash rate that doesn't move until right at the end of next year. And that's not what we're all expecting. Why? The Reserve Bank points to some sticky and high domestic services inflation. Now, drilling down through that, the Reserve Bank points out most of this is around residential rents, around council rates, and around insurance premia. So that's the reason why interest rates are staying high for longer. But what can be done about those things? Because the whole point of monetary policy is that high interest rates filter through into spending and investment decisions and therefore change people's decisions about pricing of goods and services. But remember, these are 3 things: residential rents, council rates, and insurance premia, which aren't necessarily connected to interest rates. For example, council rates, they're decided by a council. And actually, high interest rates make it more expensive for a council to service its debt. And you could argue they would increase their rates even more with high interest rates. Now, councils also have a problem in that the central government has suspended a lot of the capital grants and revenue help they were expecting from Three Waters. And the government has generally been quite tight with the money it's been giving to councils to help them pay their bills. So councils are saying, well, we don't have the money. The big councils have hit their debt limits and are saying, right, we're going to put up our rates. So there's not much the Reserve Bank can do about that. In fact, you could argue it's the government's fault that inflation is quite high. Secondly, residential rents aren't necessarily influenced by interest rates either. Now, if you're a landlord and you took a cost-plus approach, you could argue that higher interest rates actually encourage you to put up rents even more. Now, in my view, I don't think that's true. It's got more to do with demand and supply. But certainly the huge supply imbalance we have, not nearly enough homes for way too many people has led to rent inflation. And it's clear that monetary policy doesn't really change that underlying supply-demand imbalance. In fact, you could argue that high interest rates actually make it more difficult to build new homes and solve that supply problem. And then finally, insurance premia are up and have been for the last 3 or 4 years in response to these shocking climate events. And it's clear that climate change is going to increase the cost of insurance. And that is, again, something that a Reserve Bank and an official cash rate can do nothing about. The climate is going to ignore what the Reserve Bank is doing. So this blunt instrument is turning into a bludgeoning tool and punishing people who have already paid with higher rates, higher rents, and higher insurance premia, and now they're paying again with high interest rates. Now, the Reserve Bank is going to stick with it. It's got that tool. It's a blunt one. It's the only one it's got, and it's going to argue, we've got to reestablish our credibility and get inflation down. But it's a real problem, not just for those people who are having to pay high interest rates if they're borrowers, but also for the government. This week on When the Facts Change, I talk with Jarrod Kerr, who is the chief economist at Kiwibank, about the interesting events of this week. Remember, it was a more hawkish than expected result from the Reserve Bank. And we talk about an interesting theory that's bubbling up from the rest of the world, that high interest rates actually increase inflation, in part because there's a whole bunch of savers who now have more money in their pockets from higher interest rates. That's this week on When the Facts Change. We go into monetary policy in depth and talk about money going in all directions and whether the official cash rate should stay this high. Well, kia ora, and welcome to Jarrod Kerr, the chief economist at Kiwibank, on a big day for us interest rate nerds. That is the monetary policy statement from the Reserve Bank, which is every 90 days, every quarter or so, the Reserve Bank will come up with a new set of forecasts and make a decision on the official cash rate. We're speaking, Jarrod, on the afternoon of that decision this week. So could you tell us what actually happened?
Kia ora, Bernard, and thanks for having me back on. Look, what the central bank did was surprise markets a little bit by lifting their OCR track, which is their forecast for where they think interest rates are going to track over time. And they just tweaked it up a little bit. They're giving the market and economists like myself a bit of a warning that, you know what, we're not cutting anytime soon, and if there is a risk in the near term, it's a hike, not a cut. What they're telling us is that, you know what, we are winning the war on inflation. We've just got a few more battles to win.
Yeah, you used a word I wasn't expecting, the word hike in there. Did the Reserve Bank actually consider hiking?
Yeah, they did. So they're looking at the upside surprises that they've seen domestically. So domestic inflation's running too hot. There's no question about that. Where we've been getting relief is the imported inflation from offshore. And they actually put a box together today, which I think was quite interesting, showing that there are certain parts of the inflation basket that are quite sensitive to interest rates. They've moved. There's some parts that are sort of medium, take a little longer. They've moved. And then there's some parts like household insurance, rates, council fees, that sort of stuff, that aren't as interest rate sensitive and take quite a bit more time to get under control. So they're looking at those, and as we know, we've had a cyclone, we've had all sorts of things that are pushing insurance costs higher, just climate change in general. Councils are up to their eyeballs in debt with massive infrastructure projects they need to get done, so rates are going higher. There are some interest, parts of that basket that just simply aren't influenced by interest rates. The other bit was rents, and that's been lifted by migration.
Yeah, we know that the Reserve Bank is there to try to slow down the economy and speed it up to keep inflation within that 1% to 3% target band. And it's sort of intuitively right that if the economy's too hot, you whack it with some interest rate hikes and that'll slow things down, because people who have less money in their pockets to spend, particularly the borrowers, they're going to take some of the heat out of the economy. And if businesses find that when they redo their numbers with higher interest rates, they're going to invest less, and therefore there's going to be less stress on resources in the economy. But when you look at those things that the Reserve Bank talked about, so rents, rates, insurance, those are things which really couldn't give a toss about interest rates. They're a function of almost policy decisions. So, for example, rates, there's no competitive market there. The councils are doing that. And you could argue it's something they're doing because they feel that they're not getting enough help from the government itself. And they're also having to deal with high population growth and all the infrastructure needs that go with that. And on the rent side, there's a structural undersupply of housing and migration that's moving. It's unlikely interest rates are going to change that. So is the Reserve Bank flogging the economy like it's a dead horse here? I mean, what's the point?
Had they hiked, we'd all be saying exactly that. Yeah, bang on. They have done enough to cool down all those parts that are sensitive to interest rates. So they've done a good job there. And, let's not forget inflation has fallen from 7.3 to the 6s to the 5s to now 4. And on our forecast, it'll be below 3 by the end of the year. What they're worried about is what we've seen in the United States, where inflation fell to 3% in June last year and has stayed there for the best part of the year. It looks like that last hurdle, that last bit, which includes the parts that aren't sensitive to interest rates and relies on them coming off at a time when we're all facing, higher costs around climate change and these sorts of non-interest rate sensitive prices. So it is a difficult job, and I think they're looking at their own forecast and saying we've got risks both ways here. There's upside risk which we can't tolerate, and there's downside risk that we would just absolutely embrace with open arms. We want more time. That's how I read it. I read that pushing out of the OCR track as being a central bank that just wants more time to get more data and hope that we do see inflation fall below 3 and back towards 2. So, the market not that long ago was flirting with the idea of rate cuts as early as August. That's been pushed back. And I think, the chances of rate cuts this year, full stop, are likely to be pushed back. We will be wrong on the timing, but I think we'll be right on the direction. The next move will be a rate cut. It's just taking longer.
Yeah, so when does the Reserve Bank currently expect it might be able to cut rates? Because it's sort of pushed out its expectation by about 3 months or so.
Yeah, exactly. Pushed it out by a quarter from the middle of 2025 into the third quarter of 2025. That's a very clear signal saying, look, it just feels like it's going to take us that much longer to get back to target. And fine, we have to take that at face value. The central bank's telling us, look, domestic inflation's just too high. It's not where we need it to be. We're going to have to keep policy restrictive for longer, and that's a message for Kiwi households and businesses. We all thought rate cuts, might be coming this year. Maybe it is a 2025 story.
And I wonder, though, can the Reserve Bank take into account a tighter government spending stance in its considerations here? Can it sort of second guess the government? They've heard all this noise about spending cuts and about tighter budgets. Can the Reserve Bank look at that and go, right, okay, we're going to have, a tightness from the government and therefore we can afford to be just a tad looser? Or are they saying, well, we don't really know yet. We haven't seen your budget. We're not going to assume anything different. What's the situation there?
Well, it's under my understanding, they will have the numbers or most of them. So they'll have a pretty good idea of what's going to come out in the budget next week. So that would have gone into their analysis today. Obviously, they can't comment directly, but they will have, I think, a pretty good understanding of the government's position. And, taking that into account, they've come out with a slightly more hawkish commentary today compared to February. So read into that what you will. I can't really comment until we get the budget numbers next week, but the government is clearly in a difficult situation where the economy's gone through quite a recession. Their tax base, their revenue projections have proven to be optimistic, to put it nicely, and that puts yourself in a very tough position when you're wanting to do a bunch of stuff, right? They want tax cuts, they want to increase spending on infrastructure, they want to boost healthcare and education. We'd love to be able to spend more on everything, but unfortunately there are finite resources out there.
Now, just thinking about how borrowers, those on fixed mortgage rates in particular, will have to think about the next 6 to 12 months, because where earlier this year or maybe even last year they might have thought about now we might be getting some significant cuts in fixed mortgage rates. And of course, the OCR isn't the only game for fixed mortgage rates. They're moving for all sorts of other reasons as well, including what's happening on global markets and in particular US interest rates. I mean, is it remotely possible people could get their rate cuts even if the official cash rate isn't cut?
Well, we have seen bank mortgage rates come off a little bit, I think 10, 15 basis points over recent weeks, and that is without the Reserve Bank moving the cash rate. That is wholesale markets factoring in rate cuts, which today have been kind of pulled back a bit. So we have seen wholesale rates rise about 10, maybe 15 basis points on the back of today's announcement. And that was only a little while ago. So I think that could push even higher. That kind of moves back against what banks have just done in providing some relief. I do think that in the next 6 months, the probability of interest rates going up or down is still tilted to the downside, in my opinion. We could get to the end of the year and we may not get a rate cut, but we're pretty certain we'll be getting rate cuts in 2025, which will be factored into those rates. So a 2-year rate, for example, in a year's time, that's looking at where those rates are likely to be. So that 2-year fixed rate, I think, the end of this year or slightly into next year will be lower than where it is today.
So how might this affect the economy? Because even though the Reserve Bank didn't physically do anything, its forecasts and its commentary can have an effect on the economy. We all remember cool your jets, and eventually we did. But what's the prospect now for the economy, for employment, unemployment, retail spending? Now we've heard from the Reserve Bank that it's being a little bit more hardcore about it, and it may not even cut rates until towards the end of next year.
Well, look, I mean, the way we see things, it just continues along the path that it's on. We were factoring in rate cuts to start in November, and for that to provide a bit of a tailwind for growth into next year. We're going to have to review that. We'll have to think about whether they will be in a position where they can cut in November this year. They're telling us they won't be. So if that is the case, then things over the next few months will just keep moving along. But those tailwinds that we were factoring in, that bit of a step change in property markets, in asset markets in general, in business confidence and household confidence, I think may be delayed into next year, which is not good from our perspective. We think they've done enough to tame the inflation beast at current settings, and could go in November. But if we find ourselves in a position where the Reserve Bank's not cutting until next year, it just prolongs that weakness in the economy, that restraint in the economy.
Now, this is not the only country in the world which is seeing this problem. The US Federal Reserve seems to be waiting before it cuts interest rates, and it's been the story of global financial markets this year, is this edging out almost constantly of the view about when the US Federal Reserve cuts. And in other countries too, there's been this, last mile problem. It just seems so hard to get it down to that last bit. Now, and I've heard in recent weeks a really unusual set of explanations from some people you wouldn't expect to say things like this. BlackRock, in particular, one of the world's largest investment fund managers. So we're not talking a bunch of, green lefty modern monetary theorists here. We're talking about BlackRock coming out and saying, hey, we're wondering whether higher interest rates is actually stimulatory, because we all forget, sure, there's people who borrow money and therefore they're paying more to the bank or to other investors in bonds, and therefore they're not spending and they're not stimulating the economy. But on the other side of the coin, there are some people with term deposits and savings and maybe bonds who are suddenly getting more money because interest rates are up. And that's, they say, the reason why the economy just keeps on going quite strongly in the United States, and there's still plenty of inflation pressure. That all of this extra interest payments on term deposits and savings and bonds is being spent in the economy and stimulating it. What do you reckon about that?
Yeah, I mean, I love it, to be honest. It's a conversation we need to have, and being an economist, frothing at the mouth when we get to talk about stuff like that. But for me, there's a demographic point here. So we've all learnt from the 80s and the 90s and the 2000s that you lift interest rates and you have this sort of an impact. We now have baby boomers retiring. So as you go through your life cycle, you start off as a bit of a saver, and then you get into debt. You take on the most amount of debt when you're in your 30s and 40s. You pay it off quick, smart, and then next minute you're a saver again. So we have a growing proportion of our society, baby boomers, moving into that net saving position, right? Which kind of goes to your point. Now, higher interest rates, I always have to say when I'm typing, higher interest rates is going to hurt, because I know that I will get responses from Kiwibank customers saying, actually, higher interest rates we want, and that's your baby boomers. So you've got to look at both sides. Yes, higher interest rates for those who earn interest on their life savings is a big plus. We also heard from them during the COVID crisis when interest rates went close to zero. They were screaming, right, the other way around. So now they're doing better. You can get a term deposit which is 6%. Loving that. So I think that is an interesting point, and maybe our demographics have changed a little bit, and that it's not quite so obvious. But everything we still know and everything the central bank still went through today does suggest that interest rates, we all believe, are restrictive at these levels, and that means the economy has slowed, and we've seen a 4 out of 5 quarter recession in New Zealand. We're not mucking around. This is a double dip recession, and it's down 3% on a per capita basis. So you can't sort of sit back and say they've lifted rates and the economy hasn't been dented by it. Well, no, the economy's been steamrolled by it. It has had an impact. What we're facing here is what you pointed to with the US and other countries. It's that last mile. I think what you said is quite a good way of putting it. I'm going to steal it in my research. And so it's that last mile that we're worried about, and it's proven to be difficult to contain.
Jarrod Kerr, the chief economist at Kiwibank. Jarrod, fantastic to have you for 17 minutes on the busiest day of your year, or one of the 4 busiest days of your year. Really appreciate it.
Thanks for having me.
When the Facts Change was brought to you by the Spin-Off Podcast Network, together with Kiwibank. Visit kiwibank.co.nz to find out how Kiwibank are making Kiwi better off.